I just cracked the code on something that I heard was impossible for years. And I'm not just talking about other life insurance agents, but also the life insurance carriers themselves. I'm talking about finding the net internal charges of whole life insurance. I'll be showing you how I reverse engineered a formula to help me uncover the net internal charges of whole life insurance and the implications of what I found. And I'll be answering your most pressing questions, like how the policies pay for themselves and what the cost of the guarantees are. As I'm doing that, I'm going to be doing it from 4 different life insurance carriers that you see right here. But before we start doing that, it's important to actually talk about what net internal charges of whole life insurance are. And you might have noticed, but the dividend interest rate for your policy is not the literal internal rate of return that you see in the cash value. Why is that? And that is because of the net internal charges. And so I have this presentation prepared for you to kind of show you how those are getting assessed, what the impact of those are, but then also what you're getting kind of in return after everything is said and done. What's the drag on your policy? And the drag on any whole life policy is basically the internal net charges. This is money that's getting deducted from the cash value on an annual basis. All these values are very proprietary. I had no access to any of this information. I found everything that I discovered simply by looking at the illustrations I was able to run. And all of these are also expressed very differently. So there's no way I can tell you exactly what each of these constituent parts of the whole are for each carrier, but all of these are playing into the wider picture. Now, the first part of internal net charges is expense charges. This is like salaries. This is marketing. This is just keeping the lights on at the carrier, right? This is part of the cost of doing business. The mortality experience. Now, this is not necessarily a charge as much as it is a factor or a multiplier, but basically every year, the carrier is going to set aside money to pay out on death claims. And at the end of the year, essentially, they're going to assume a certain amount of people will have died. And then by the end of the year, they're going to figure out if more people died than they thought or if less people died. If more people died than they thought, then that's going to mean they had to pay out more in death claims. That's going to decrease the amount of dividend they're able to give all their policy owners for the year. Conversely, if fewer people died than they expected, they're going to be able to give out a bigger dividend than they were expecting because they have more money left over. So that's mortality experience. Now, next, the PUA load fees. So out of every dollar that you fund in PUAs, there's a small percentage that is assessed as a load fee. Now, sales commission and renewals. Now, this is a thing for the life of the policy, but it's much more concentrated up front. So the sales commission and renewals is part of the cost of them doing business. Agents get paid to bring business to the carrier, and they get paid in the form of commission and renewals. Underwriting and APS. So when you went through underwriting, there's a cost to paying all those people their salaries, but then also requesting, medical records and whatnot. And so all of these also factor into the overall cost of doing business with the carrier. So that's everything that's essentially holding back the growth of your policy. Now, what's lifting your policy up? Now, your lift on your policy is your behavior, or whether or not you fund it the way that is illustrated. That's probably the most important thing. You're also getting dividends because all the carriers that we are looking at are mutual carriers, which means they are owned by the policy owners and not stockholders. And because they're owned by the policy owners, you are entitled to a share of its revenue. And you get that in the form of dividends. These dividends get reinvested into your policy, and they are going to grow your policy exponentially over time. Also, the lift is this uninterrupted compounding due to the tax advantage status. So all of these 3 things together are lifting your policy. And realistically, both the drag and the lift are happening simultaneously. Whole life is a bundled product. All of the things that you see here are baked into the numbers that you already see in your illustration. These aren't extra things that are added on top of it. These are already assumed to be happening inside the numbers that you see. Here's a great example that I came across with one of our carriers that just kind of explain to its clients how the mortality experience and expenses and the net internal charges get assessed. And like I said, I think they just did a great job here. And I talked to every carrier that you were about to see, to our contacts there, and they didn't divulge anything proprietary, but they did tell me that, yes, this is functionally speaking, roughly the way that the internal net charges get assessed to their carrier. So this is functionally speaking pretty much the way that it works everywhere. So you're going to take the cash value from last year, right? So the ending policy cash value. You're going to add the amount of premium that you funded this year, and then the net charges get subtracted from that, which, in this example is $612, and then you get a certain number. That number, whatever that number is then multiplied by the current dividend interest rate for that year. Then that number, which is 1565, gets added back to the number that you got after the mortality experience and the charges and were subtracted. It gets added back to that. And then that number, the addition of those numbers, is the current year ending policy cash value, which in this example is 27,651. So like I said, just a really kind of easy way to break it down. It's actually more complex than that. It's not just this simple, but this is roughly speaking the way to find it out. And what I did is I took this idea and I turned it into a formula. So here is what this looks like in a math formula, right? So you have your cash value sub n, and sub n means like current year, and that equals a CV n sub n minus 1. And so that's last year's cash value plus the premium minus the deduction times 1 plus the dividend interest rate. So that is how you find the cash value. And the cool thing is that when you look at your illustration, you can find every single one of these values on the illustration except for one. And that is where I had this idea. I had the brain blast. I was like, what? The only thing I actually don't know from the illustration is the deduction. But if I scrambled this formula, I could figure out the deductions that are happening. Scrambled, if you want to find the deduction, you just take the last year's cash value plus the premium minus the cash value this year over 1 plus the dividend rate. This is what I found, basically. Before we get started, there are some assumptions that are taking place, and I did my best to make everything here apples to apples so that it's actually like a fair comparison. So I took 4 different carriers that you saw earlier, and I built policies at each of those carriers. They were all for a 25-year-old male, standard health, not great, not horrible. Now, the base to PUA ratio ranges are from around 397 in the first year to about 3070, which is a pretty big split, but I'll explain why I did that. It's all non-MEC, high early cash value design with a maximum of 250,000 in the first year. And then for all carriers, a maximum of 50,000 year 2 onwards. Due specifically to the strengths of the carrier, I designed them differently because it's really not fair to design like a one size fits all policy across all carriers because all carriers are a little bit different and they all have their strengths. So some carriers are really good for a maximum cash value design or a consistent amount over time, whereas other carriers are really good for what's called a front load, which is where you put a big dump in the first year. And so for 2 of the carriers, I did front loads of 250,000 and then followed by 50,000 a year. And then the other carriers, I did 50,000 a year, followed by just 50,000 a year. The apples to apples part though, is that in all of the carriers, $2 million got contributed over a 50-year period. And once that $2 million number was hit, then a premium offset gets instituted. So that is basically capping the amount at $2 million. No more money gets funded into this policy. And then at that point onward, it's just the strength of the dividends that the carrier is giving, and then also the drag of the internal net charges. So the internal charges or deductions that we're going to find out here are actually a combination of what we just saw in the last couple slides is the expense charges, the mortality experience, which is expressed as a multiplier, the PUA load fees, and the sales commission and renewals, along with the underwriting and APS. So that's what the deductions are, right? And I don't know the constituent parts of that number. I don't know how much of each of these numbers is each one of those, but I know like cumulatively, this is the amount that had to be deducted from this policy in this year for this to work, for these numbers to work out. Now, this assumes that the charges and mortality experience and the dividends of 2026 are going to stay exactly the same for the next 50 years, which, as you know, is pretty bonkers, right? There's no way that's going to happen. Now, but even though it's not going to happen exactly that way, this is going to give us a really kind of decent picture in a broad sense of how these policies kind of pay for themselves over time, what the cost of the guarantees are, and just kind of how it works, right? Is because there's nothing magical here. It's all math. And ultimately, these policies have to be paid for in a way. And the internal net charges are one of the ways these policies get paid for. And so these internal charges are incredibly specific to the specific policies I built and are in no way representative of every policy that could be built at that carrier. So don't think that I'm saying this is what everyone is. This is incredibly specific to the way I built it. Like I said, you want to take a broad view to this data rather than thinking that this is like an explanation of how your policy works. This is the way, kind of a way to think about internal net charges as a comprehensive whole. All right, so first carrier, Penn, I put in 50,000 a year. And so this is the first page of the basic ledger, just so you can see. So the base premium in year 1, 6,024, 12% of the first year premium, years 1 through 33, 50,000. Years 34 through 50 over here to the right, as you see. So it goes up and down, and it's all because I told the illustrator to not mech it. And basically by year 50 though, there is a total contributed of $2 million. All right, so that's Penn. That's the way that one looks. Now, Lafayette Life. So here's this one, 250,000 in the first year, followed by 50,000 a year for several years. And then it will be 46,480 a year for many years after that. Now, Lafayette Life stats. The base premium for this is $8,000, which means the percentage of the total first-year premium of $250 is only 3.2%, which is so low. Year 1 is $250,000. Year 2 through 7 is $50,000, and then the term rider drops off. Year 8 through 37 is $46,480. Year 38 is $39,600, and years 39 through 50 are a premium offset, which means that the total contributed by year 50 is $2 million. Here's the Mass illustration. As you see here, $50,000 a year going straight into the policy. Now, Mass stats and funding, the base premium, $15,000. All right. So this is actually the highest total percentage of base premium across any of the carriers. And it's just one single factor among many that impacts performance. So this alone does not impact the entirety of the data for Mass. It's just one thing to be aware of. So percentage of total premium first year, 30%. Years 1 through 39, 50,000. Year 40, 49,200. Years 41 through 50, premium offset. And the total contributed is $2 million. It's actually about $800 shy of $2 million, but rather than writing that really long number out, just know it's $2 million. Okay. So Mass stats and funding. Now, Guardian. So here's the Guardian illustration. Guardian has a really strong front load, right? So you see 250 there in the first year, 50,000 a year for many successive years. So Guardian stats, the base premium is 9,000, which the percentage of total first year premium is only 3.6%. Year 1, 250,000. Years 2 through 28, 50,000. Years 29 through 39, 18,182. Year 40, 18,170. Year 41 through 50 premium offset, which yields $2 million of total contributions over a 50-year period. All right, so that is the way that I designed all of these policies. And now you're going to kind of see, rubber hits the road. What's going to happen? What are the internal net charges going to be like? And I think you're going to be really interested because this is ultimately a peek under the hood that I really don't think anybody's really ever seen before. Here is the annual internal charges comparison across 4 different carriers over 50 years, right? So this is looking at the deductions. What's getting deducted from these policies on an annual basis. So you see here on the left-hand side in year 1, that's the first year of these policies. And there is a pretty big divergence from these 4 different policies. You'll see the green line is Guardian up there at the top. The red line is Penn. The purple line is Lafayette Life. The blue line is MassMutual. The highest annual internal charges right off the bat are Guardian and Lafayette Life, and Penn and MassMutual are much lower, but that's because the style of policy is different. The Guardian and Lafayette Life had the front load, MassMutual and Penn just had the max cash. So you're putting in a lot less in year 1. So just because there's a lot higher internal charges, that's really just specific to the way that this policy was designed. But once again, I was playing to the strengths of that carrier. Now, you'll see in year 2, all the line drops significantly for Guardian and Lafayette Life, and all the carriers are pretty much in a very similar ballpark, right? Like the lowest you see there is kind of MassMutual, which is a little under 10,000, and then the highest looks like it's Lafayette Life in year 2, which is maybe 15,000 or so. So pretty much all of them have 50,000 a year going into the policy in year 2. So it's a very similar range across all 4 carriers in terms of the internal and net charges. Now, as time goes on, you're going to see that there is going to be some distance between the two. And over time, from years 1 through years 50, you see some that are clearly different than the others. And so that red line of Penn is lower than the rest by a long shot. So the lowest annual internal charges goes to Penn for their accumulation whole life product. And right now that dividend interest rate is 6%. By year 50, the amount of total deductions from the cash value of the policy is just under 100,000. Whereas at Guardian, which is the highest, the deduction from the cash value of the policy is over 150,000. Both carriers are doing the same thing, is that you have a policy and that policy has a death benefit and a portion that you can use before you die to invest in income producing activities. They're both doing the same thing, but they're doing it in different ways. Now, in the middle are MassMutual and Lafayette Life, a little bit more similar to each other, but has higher annual internal charges than Penn Mutual. It's really important though to not just look at that, because if you look at that, you might be like, this is like a horrible liquid savings tool. I can't believe what's happening inside here. You can't look at that without looking at the total cash value growth at the exact same time. This is an equally important graph to look at. So what you're starting at here, all the carriers starting at very little cash value in year 1, and then by year 50, it's a ton of cash value. So as you see, the Lafayette Life and Guardian lines start higher because there's more in year 1. There's 250 rather than 50. And you'll notice though, this is the cool part, is that the Lafayette Life purple line kind of looks like it's highest over the course of the entire graph. But the Penn Mutual line, which starts lower, like it doesn't have as big of a dump in that first year, it catches up to it by year 50. So you've contributed 2 million in each scenario, but over time, the cash value grows quicker at Penn than it does Lafayette Life, even though Penn didn't have that big dump in the first year. Now, you'll notice that even though Guardian started at the top in terms of the total cash value, by the year 50, it is kind of near the bottom. It's actually kind of significantly lower than the other three. So you'll notice that the Penn and the Lafayette Life ones are kind of midway between 10 million and 11 million, so about 10.5 million or so. And then the Mass one is right underneath there. It's about 350,000 beneath, right? So Mass is about, even though it was funded virtually identically to Penn, it's roughly 350,000 or so less in total cash value over 50 years. And then the Guardian one is just over 9 million. It's about 1.3 million less of cash value than Lafayette Life and Penn. And also, interestingly enough, Lafayette Life and Penn are almost identical at year 50 if it is funded in this way. This is also, once again, very important that you recognize that your behavior is so important to make these numbers work, because if you funded these policies in exactly this way and the internal net charges didn't change, the mortality experience didn't change, the expense management didn't change, if all of these things didn't change, then yes, Lafayette Life and Penn would be pretty much at the same place at year 50. You have to take into account both the annual net charges and the total cash value growth over time, because ultimately one does not happen without the other. Yes, you are getting these internal net charges, but you are also getting this incredible growth that's happening inside your policy at the same time. Now, here is the net cost, or the area underneath the trend line over 50 years. So what I did is I took each one of those lines and I basically told my software, like, hey, I want you to measure the net area underneath each line, and that's going to give me the cumulative amount of cost or deductions over 50 years. And so over 50 years, the lowest amount of deductions out of any of the carriers that we work with is Penn. So it was Penn. It was 1.29 million in this policy built in this way over a 50-year period. The next lowest was Lafayette Life. Once again, 2 million over a 50-year period. This was the contender product. 1.93 million. The MassMutual HEC V was about 2.08 million. So very similar net cost between Lafayette Life and Mass. And then Guardian was the most at 2.71 million. That's the whole life 95. So as you'll notice, like the Penn is actually less than half of the internal net charges that Guardian is over the same time frame. Here's some different observations. Now Penn, I'll call Penn the efficiency king here, right? Has the lowest internal net charges of any carrier, and consequently, at least the we work with, and consequently the most efficient bang for your buck with the leanest chassis, right? So while it doesn't have the best early cash value liquidity, it does lag behind Mass in years 1 through 4. It outperforms Mass by nearly 300,000 by year 50. It also manages to attain an equivalent cash value in year 50 as Lafayette Life, even without a similar dividend head start with that massive dump in the first year. Because when you put in 250 rather than 50, you get much more dividends right away in Lafayette Life than you do at Penn. So like there's this kind of scaled advantage that Penn overcame because it has such a lean chassis, right? So this means that the internal net charges were lower at Penn than Lafayette Life, which increased the overall efficiency of the policy. And this allows it to retain more of its gross dividend than anyone else that I did work on and that I studied, basically. It also allows it to overcome Lafayette Life's advantage of that initial 250 rather than just like the 50,000 that Penn had. Now, it has the lowest cash value liquidity of any carrier, but it more than makes up for it in long-term cash value accumulation. Now, this is important to say that numbers here assume that no policy loans have been taken, which would otherwise impact performance and dividends since Penn is a direct recognition carrier. Now, Lafayette Life, what are the observations here? So I would call Lafayette Life that you can have your cake and eat it too carrier, right? I would say the best combination of year 1 liquidity and long-term cash value accumulation. And this is specific to if you have a lot of capital that you're looking to redeploy. And if you have that large amount of liquid capital and you can put it in the first year and follow it up very consistently year 2 onwards at least 20% of year 1, then the best combination of year 1 liquidity and long-term cash value accumulation. It does have significantly higher internal net charges than Penn, about 1.93 million to about 1.29 million. It has a faster break even than Penn, or when there is more in the cash value than you personally contributed. It happens in year 4 at Lafayette Life versus year 6 at Penn. And even though it must have higher internal net charges than Penn, its internal charges are still low enough that combined with a big front load in year 1 allows it to outperform a lower death benefit but max cash style policy at Mass, just like Penn, but it outperformed that over time. Now, this is a very strong hybrid contender. It doesn't win the absolute lowest net charges trophy, which Penn does, nor the absolute best year 1 liquidity trophy, which Guardian does, but it is excellent at both. And the cool thing here is that the numbers will be identical whether or not policy loans are taken, because they are a non-direct recognition carrier, which means you're going to get the same dividends regardless of whether you've loaned against your dollars or not. Now, here's some Mass observations. All right, I would call Mass the incredibly solid all-around player. Has the highest average dividend interest rate of any of the carriers that we tested over the last 20 years. But as you will see, just because they have a high dividend rate does not necessarily mean that they have a lower net internal charges. They might have high dividends, but also high internal charges. But I will say they have the highest average dividend rate of any carrier that we tested. It nearly ties Guardian for year 1 cash value liquidity, but the low internal net charges outperform the dividend head start advantage of Guardian's $250,000 year 1 dump in by year 50. So it still has really nice low internal net charges, but it must have higher net internal charges than Penn, even with an identical amount of annual premium, because even with the higher declared dividend rate, because this year was 6.6% at Mass and is only 6% at Penn, the cash value of Penn has an additional $350,000 by year 50. So the internal charges must be higher. Now, it does have the same break-even point as Penn, which is policy year 6, but in policy year 6, there is also $900,000 more of death benefit. And at Mass, the numbers would be identical whether or not policy loans are taken. And this could make it, more attractive than the Penn policy if you expect to frequently be taking policy loans, because ultimately you're going to get those numbers regardless of whether or not you borrow. Now, some Guardian observations. I would call them the best early liquidity and the lowest minimum required premium carrier. Now, they offer the highest year 1 liquidity and conservative growth, but this safety comes with a notable opportunity cost in cash value growth. They are about 1.3 million less than the leaders by year 50. And even though its funding pattern is identical to Lafayette Life, which is, $250 in year 1 and $50,000 a year thereafter for a while, and its dividend was a full 35 basis points higher, right? This year at Guardian, it's 6.25%. This year at Lafayette Life, it's 5.9%. It had the lowest year 50 cash value numbers by a long shot, 1.3 million. Now, this implies that the internal costs are also higher than Lafayette Life and double those of the Penn policy over the 50-year period. And the death benefit is also about 1.8 million less than the Penn policy by year 50. And also the numbers assume that no policy loans are taken, which would otherwise impact performance, since it is a direct recognition carrier for the first 10 years. Like I said, I've been doing this for like 4 months. And so I was doing this back in 2025 and I had run numbers on policies in 2025. And I want to put this in here just to show you how consistent these numbers are year to year, even though certain numbers change, like the performance seems pretty similar. So I ran the numbers in 2025, once again, 25-year-old male, standard health. I had the base PUA ratios a little bit tighter, about 1585 to 3070. And it's because rather than having an apples to apples on the total amount of premium, I just wanted to look at the apples to apples in the annual premium that gets contributed. Similar thing, non-MEC, high early cash value design, but a 10K annual contribution where the total amounts contributed by year 50 vary. So it's not necessarily apples to apples by the end, but the amount that's getting contributed per year is the same. Now, the internal charges and deductions are actually a combination of the expense charges, the mortality experience, which is expressed as a multiplier, the PUA load fees, the sales commission, and the renewals, right? So the deductions are all the same. What's interesting here is that, once again, this isn't the charges and the mortality experience, the dividends of 2026. This is the charges and the mortality experience and the dividends of 2025. And that's going to stay exactly the same for the next 50 years, at least in this scenario, which we know is unrealistic and is not going to happen, but it does just illustrate the way that these policies effectively pay for themselves over time. And it kind of shows you what the cost of the guarantees of these policies are. Now, these internal charges, once again, are incredibly specific to the specific policy that they built and are in no way representative of every policy that could be built at this carrier. As you see here, the lines are very similar, even in the position relative to each other in the graph. You have Penn, you have Guardian, you have Lafayette Life, MassMutual, same colors. You'll see that in the total annual charges, Penn is also, once again, at the bottom, even at $10,000 a year. This is the same product with the same dividend rate, and Penn is still the lowest. Now, Guardian, the green right underneath it is in 2025, this is the same product, which is Whole Life 95, but this is at a lower interest rate in 2025. They actually raised their interest rate a little bit in 2026. So it has a slightly lower dividend interest rate in 2025, but it is still the highest total annual charges across 4 different carriers. Then Lafayette Life in the purple, you see there. Now I used a different product in this one than in the 2026 one. That's the only one that I switched the product up on. And that was really more of a minor tweak than everything. Here I used the Patriot 2022. In the 2026 one, I used the Contender 2022. And the dividend interest rate rose from 5.75 in 2025 to 5.9 in 2026. So, but as you see here, it has the second lowest total annual charges across 4 different carriers, just like it was in 2026. And MassMutual, I use the HECV, which is the exact same as the one I used in 2025, is in 2026. And the dividend interest rate was about 20 basis points lower. It was 6.4% in 2025, and it was 6.6% in 2026. So those are the differences, but you'll see that it's roughly the same. And even though I didn't play to these carriers' strengths, I didn't do a front load, I just put 10,000 into each policy, it still is kind of roughly coming out to the same thing. The difference here is that it seems that Guardian and Mass were pretty much the same amount of total annual charges by year 50. But once again, I was not playing to these carriers' strengths when I wrote these. So I added up the area underneath the trend lines to get the total cumulative charges. Once again, Penn is the cheapest at over 50 years, $250,000, and Lafayette Life was the second cheapest, about $307,000 over that 50-year period. MassMutual at about $381, and then Guardian nearly double Penn at $486, which is very similar to what it was in the last one, which is, the Penn was roughly half of what Guardian was as the most expensive one. Now, some broad observations we can draw from these, right? This whole video is about broad observations, right? Is that the performance over time of the 2025 10K max cash policies across all 4 carriers and the 2026 policies that were designed according to the carrier strengths, which is front loads versus max cash, remained proportionally consistent over time. Now, this comparison clearly demonstrates that a higher dividend interest rate does not necessarily translate to higher long-term performance. Now, Guardian had the second highest dividend, right? It had 6.25% compared with MassMutual's 6.6%, but it had the lowest long-term CV numbers by year 50. Now, policies with high dividend interest rates might have accordingly high internal net expenses. And as dividend rates rise, many carriers also raise their expense ratios accordingly. Now, front load efficiency. Now, as shown by the 2026 graph, the long-term efficiency of your policy's cash value growth depends mainly on your behavior. So the 250,000 Lafayette Life front load that had nearly equivalent cash value to the 50,000 max cash by year 50, that had, essentially the exact same behavior for both policies, right? Is that they were being funded all the way up to the limit that they were designed to take. And the additional lifetime compounding that took place inside the Lafayette Life policy with the front load in the first year made the policy identical in cash value growth with the non-front load, but also had lower internal net charges policy at Penn, right? So that front load efficiency can kind of overcome a little bit of that loss of efficiency by the internal net charges. Now, the give and take here is that as your cash value increases, the amount of your dividends grows, and so do the lifetime charges on your policy. So as your cash value starts to go up, your internal net charges are going to go up as well. What are we going to do with all that information? Well, the thing we're going to do is we're going to compare it to the most similar asset that we possibly can, which is a high yield savings account. So in one hand, we have a whole life policy, on the other, that high yield savings account. Let's look at this apples to apples and compare the two. Which should you go with? Which is going to have that better compounding environment? So let's talk about the assumptions that I use for a 2026 high yield savings account. Okay. The apples to apples, the amount getting contributed is the same, $2 million, which is $50,000 of annual contributions for 40 years, and then interest only, sort of like the premium offset for the whole life policies from years 41 through 50. And here's where I'm giving it a huge benefit of the doubt, right? Consistent 4% pre-tax interest rate for 50 years, which is wildly optimistic. Wildly optimistic, but I'm trying to give it every single benefit of the doubt that I can here, okay? Now, high yield savings account averaged 4 to 5% in the 1990s. From the early 2000s to 2021, they've averaged 0 to 1%, somewhere in that range, south of 2%. And then from 2022 to present, they've averaged between 4 and 5%. Now, like I said, there's a huge gap in there in the last 30 years when they haven't been doing well, but I want to give high yield savings account the best possible chance to succeed here. So I'm just going to call it a 4% rate for 50 straight years, which obviously is very unlikely and is incredibly unrealistic, but I want to give it the benefit of the doubt. And the interest earned in the high yield savings account is taxable as ordinary income in the year it was earned. And so I randomly chose the 22% tax bracket just because I want to be, once again, conservative, give it the benefit of the doubt. If you're contributing $50,000 a year, you're probably going to be in a higher tax bracket, but I'm just going to say, let's just imagine 22%. All right. Now here is your hypothetical high yield savings account growth. This is a 4% APY over a 50-year period with a 22% tax assessed every year. What starts in the beginning as 50,000 by year 50 is just shy of 5.5 million. And it's a very kind of straight and linear trend line. Now the observations for the high yield savings account. So the hypothetical high yield savings account growth in years 1 through 50, right? Total contributions, 2 million, 50,000 a year for 40 years, right? Now the year 40 balance right after you get done funding is about 4.07 million. Now the funding stops here, but the interest continues to accrue, right? And the year 50 balance is about 5.43 million, which is great, and the net interest, which is once you subtract your contributions, is 3.43 million, right? So that's what you get after 50 years of putting 50,000 a year for 40 years and then holding off for 10 years in the high yield savings account. Now what I did is I transposed that graph onto the whole life policies because now we're going to look at them and compare them against one another. So total cash value growth versus high yield savings account, 50 years. And so all the same policies you saw, these are for the 2026 policies, and the hypothetical high yield savings account is at that 22% tax bracket and 4% APY. You'll notice that they all start in virtually the same place, except that even Guardian, which was, it seemed like the lowest amongst the carriers, is way higher than the high yield savings account, which is to show that there's not a reason why you would or would not choose one of the different carriers just based upon internal net charges, because realistically, they're all way better than the alternative, which is the high yield savings account. So high yield savings account, you got 5.43 million. Even though the whole life policy with the highest internal net charges has over $9 million of cash value, which is a $4 million difference. Now, here is the annual internal charges or the deductions across the whole life policies and across the high yield savings account. And you'll notice here, and this is where the high yield savings account looks good because it has the lowest annual net charges. You'll see in the first year, it's at 0. And that's because ultimately you only get taxed above your basis when it comes to anything you fund into a high yield savings account, is it has the lowest annual charges. The cool thing though, in this scenario, is that the Penn policy had virtually the same annual internal charges as the high yield savings account had taxed from year 10 all the way through year 35. It was virtually an identical amount. So I thought that was pretty cool. Definitely compared with all of the whole life policies, it has lower annual charges compared with all of those. And once again, summed the area underneath the trend lines, and here's the net cost over 50 years. So with your hypothetical high yield savings account with a 22% tax rate earning 4% a year, you're looking at just shy of $1 million. And that is lower than Penn. And Penn previously had the lowest at 1.29 million over the 50-year span. Obviously, it's also much lower than Lafayette Life, MassMutual, and Guardian. Now, here's some comparison observations. Now, years 1 through 15 are roughly identical for cash value values in whole life versus the account balance in the high yield savings account. The drag from the high yield savings account taxes are roughly equivalent to Penn's internal net charges, and the other carriers are obviously higher than Penn. But the compounding curve of the cash value compared to the high yield savings account becomes much more apparent in year 20. That's when it just starts taking off. Now, the overall drag, or the net internal charges, so for whole life, over 50 years, functionally, you're going to be paying between 1.29 and 2.71 million in these policies for net internal charges. And over 50 years for the high yield savings account at 4%, 22% tax bracket, you're going to pay around, just shy of $1 million, 0.97 million for taxes. And that's a difference of cost between anywhere between, 0.4 to 1.9 million or so. And actually, I think I wrote that down wrong. It's actually about 0.3 million. So overall lift. So after 50 years for a whole life, you'll have access to anywhere from 9.27 million to about 10.5 million of cash value. Whereas after 50 years for the high yield savings account, you're going to have access to about 5.43 million at the 4%, 22% tax bracket. A couple cool graphs that I was able to build that really kind of even drive home further this point about maybe some of the different aspects of comparing whole life to the high yield savings account is the capital efficiency graph. So this capital efficiency graph is basically like what we call the break-even point that we talk about in some of our meetings, which is where you have more dollars that are liquid inside your whole life policy than you have personally contributed. Here it's called capital efficiency, which is basically just the cash value per premium paid. And so you'll see here is that the high yield savings account actually starts highest out of all the ones that are looked at, because ultimately there's no liquidity loss inside a high yield savings account. Is that if you put in 50,000, you have access to 50,000. And so it actually starts out above 100% right away, because that's just the way that it works. Whereas all of the whole life policies, even the ones that are the most efficient, are all starting out less than 100%, because once again, there are just internal net charges that they're working with. However, it doesn't take long for them to catch up. So you'll see that by about year 7 or so, the first of the most efficient whole life policies have kind of caught up to the high yield savings account. It looks like the Lafayette Life policy and even the Guardian policy are catching up around year 7 to the efficiency of the high yield savings account. You'll notice that in the beginning, high yield savings account is north of 100%, but by year 7, it's roughly maybe like 110% or so. And you'll notice that the lines cross pretty much at that point. The Lafayette Life and the Guardian policy are pretty much crossing that same threshold by year 7. So after 7 years of contributions, the overall capital efficiency is pretty much the same between the whole life and the high yield savings account. And then from that point onwards, it is much more heavily weighted in the whole life's favor. Even the Penn policy, which kind of crosses that plane around year 10, and the MassMutual policy, which looks like it crosses the plane maybe around year 12 or 13 or so, all of these will go on to have much, much higher capital efficiencies than the high yield savings account. Now, at first, the high yield savings account has the highest capital efficiency, but it does not take very long for the whole life to catch up. So here's the annual net rate of return year over year. So once again, assuming that 4% static pre-tax interest rate over a 50-year period, once you account for taxes, that's actually like a net 3.12% rate. And at first, it is the highest net rate of return because once again, there's no internal net charges like there are in the whole life chassis. However, it does not take very long, within about 4 years, for the net rate of return of the whole life insurance policies to be equivalent, which is basically just above 3%. And then so at Lafayette Life and at Penn, you see that at about year 4, the annual net rate of return is the same as the high yield savings account, as the Lafayette Life one and the Penn whole life policy. And then the high yield savings account stays 3.12% for the rest of the 50 years, whereas the all of the policies are going to be north of 4% as long as they're funded in this way, right? As you see that the Lafayette Life and the Penn policies are in the high 4s or low 5s. They're pretty soon, which I think is a really neat thing to look at. And so that you see the Penn policy, which is like the quickest to achieve that 5% rate of return, and it stays that for an extremely long period of time. And then you see I think the Mass policy here is pretty cool. Is that you see the Mass policy is that it takes a while, a little bit longer to get to that 5% net rate of return, except it actually, as you see in there in about year 40 onwards, it actually is higher net rate of return than the policy just by a little bit. Now, underneath, you'll notice that like the annual return is lowest for the Penn policy, which makes sense because the cash value liquidity in the first year is lowest for the Penn policy, but it ends up having some of the highest annual net rate of returns for the carriers. So I think that's pretty cool. So like it's cool that by within not a very long length of time, all of the carriers are achieving on a year by year basis, above 4% rate of return, which happens, it appears like in year 15. So just another cool way to look at the data in a different way in terms of annual net rate of return. Now, this is not saying that this is the internal rate of return, because the internal rate of return is essentially taking every point along this graph and then is combining it. Annual net rate of return is literally just what is that rate of return that year. It's not necessarily looking at the cumulative rate of return over the life of the policy, but it is neat to see it nonetheless. I want to give all of you like a framework, for thinking about everything that we just talked about. Now, we spent a lot of time, pulling and tugging on this data and kind of looking at it in different ways and with different perspectives. And ultimately, there's a lot of things that we've said, but ultimately broad sort of observations are what we're after here in regards to the internal net charges of whole life insurance. So what's the upshot of all of that? I want to give you guys a framework to kind of think about this in. So first off, behavior. If you do not fund these policies in the way that they are illustrated, they will not look like they are in the ways that I've kind of talked about them right here. These policies are designed to be max funded, and if you don't max fund them, they're not going to be nearly as efficient. And just like the high yield savings account, ultimately, if you don't put 50,000 a year into that, it won't even look as good as I have illustrated. And, much less the fact that the interest that I kind of illustrated for it is wildly optimistic. If you don't actually put in 50,000 a year for 40 years into your high yield savings account, you're not going to have $5 million. So it's behavior, behavior, behavior. Now, with whole life insurance, you're essentially prepaying your lifetime cost in insurance to buy a tax-free compounding environment later on. Now, the cost of whole life might be roughly double of what the associated taxes are with a high yield savings account, depending on what you otherwise would have contributed, right? In an apples to apples scenario, if you wanted to put all of your money into a whole life versus the high yield savings account, if you built it the right way, max funded it, and depending on what your tax rate was, it's probably going to be higher. It could be roughly double. So essentially the cost of insurance and the internal net charges could be roughly double of what you would have otherwise paid in taxes over that period. Now, this completely depends on the design of your policy and your behavior in funding the policy. And the end result is that you could nearly double your wealth over 50 years, right? Remember, we looked at the policies, the ones that were the best in terms of cash value growth. Lafayette Life, Penn Mutual, 10.5 million versus 5.4 million in the high yield savings account. And that's just by putting your money into whole life and unlocking the power of uninterrupted compounding. And remember that this is with the exact same contribution amount, $2 million. So the amount that you've put in hasn't changed. It's just that the vehicle or the chassis that you put it into is different. And this is because the fees of whole life are less damaging than the annual taxes of a high yield savings account. Now, for the first 20 years, the capital efficiency is pretty similar between high yield savings account and the whole life policies. But after year 20, that tax drag acts like an anchor and it holds its efficiency down. Meanwhile, the insurance policies, they hit escape velocity. They rock. You kind of see that curve just rocket upward in that compounding capital, rocketing from 200 to 400% efficiency. And every single whole life policy, though, is less liquid than the bank account for the first 7 to 10 years, right? So years 1 through 10 are like the initial climb in that roller coaster. The math only works if you're going to stay on the ride past year 10. As long as you're staying on for the first 10 years, and this is obviously not even taking into account the death benefit, really, we're just looking at the cash value here. As long as you stay on for the first 10 years, then you're going to see that compounding start, then you're going to see that wild kind of efficiency, and you're going to really see that tax advantaged growth start happening inside your policy. Now, as long as you fund a correctly designed whole life policy up to its maximum contribution limit, these efficient outcomes could be available no matter what your maximum contribution is. You don't have to put in 50,000 a year in order to see a benefit, right? Obviously, if you put in less, the numbers will be less, but the scale is going to be proportional. Is that even though these net internal charges exist, ultimately they're less damaging than annual taxes are inside a high yield savings account. And even with them existing, you're still getting a much better return per dollar contributed into this policy than if you had stayed with a high yield savings account. Now, think about it this way. This is what I'm going to leave you with. Which deal would you take? So this is the first deal is, okay, imagine that you have contributed $2 million into something. So both deals are going to be the same. So you've put up the same amount of money. Now, over 50 years, out of whatever amount that you've essentially end up with, you have to give me $970,000, right? So this is the first deal. You give me $970,000 and I gave you $3.58 million, right? So that's the first deal. So would you like to give me $970,000 and then me to give you back $3.5 million? Or would you like to give me somewhere between, 1.29 to 2.71 million? So you give me that much and I hand you back somewhere between 7.27 and 8.58 million over the same time period. Because that's essentially what this all boils down to is like, yes, when you use whole life as a vehicle, as a liquid savings tool, you're going to end up giving more money than you would otherwise if it was in a high yield savings account. Right? You pay more in internal net charges than you do in taxes, but you get back so much more over the same period. I think you'd be almost a little bit crazy to take deal number one. It's like, yeah, you do end up giving away less, but you get way less. Versus if I give you more and I get way more, like I want that every day and twice on Sunday. That is a completely comprehensive look at internal net charges. You've probably never seen it done before because I don't think it's ever been done before. Please let me know in the comments what you think about it. If this has made you interested in whole life insurance as a liquid savings tool and you want to talk to somebody better wealth about it, please do. One of the coaches here, myself included, would love to be a resource for you. We'll answer any questions that you still have and we'll help point you in the right direction.